I'm Kevin McCormley of Kiplingers, here to share some knowledge that has the power to save you money on your taxes. Maybe a lot of money. As the year winds down and the holiday season ramps up, you may be thinking of sharing some of your good fortune with others. Our dear Uncle Sam in Washington encourages such generosity by giving a tax break to those of us who itemize deductions. I'm sure that you know that what you give to a qualified charity can be written off on your return. A $1,000 gift saves someone in the 28% tax bracket $280, knocking the real out-of-pocket costs down to $720. But if you're planning on a substantial year-end gift to your church or synagogue, for example, or maybe to a charity that's out to conquer a disease that you particularly despise, let me say this: put away your checkbook. No, I'm not morphing into Ebenezer Scrooge. I'm saying there's a better way. Donate appreciated property like stock or mutual fund shares or real estate instead of cash. The beauty of following this advice is that as long as you've owned the asset for more than a year, the law lets you deduct the full market value of the asset on the day of the gift, not just what you paid for it. You never have to pay tax on the appreciation that accrued while you owned the property. And since the charity is a nonprofit, it doesn't have to pay tax when it sells the asset either. It's a classic win-win situation. Let's say you're planning a generous $25,000 gift to a cause close to your heart. If you contribute $25,000 in cash, the charity gets $25,000 and you get a $25,000 tax deduction. That will save you $7,000 in the 28% bracket. But let's say you have stock in your portfolio that you bought years ago for $5,000 and it's now worth $25,000. Donate the stock instead of the check, and the charity still gets $25,000. You still get a $25,000 tax deduction, and you get that special bonus. You avoid forever paying tax on the $20,000 capital gain you'd have to report if you sold the stock. That will save you an extra $3,000. You say you really want to hold on to the stock? Give it away anyway, and use your $25,000 you're going to give the charity to buy back the shares. That way, you'll only owe tax on future appreciation.